I love high yield investing because, again, when you get a high yield, you don't need a whole lot of Superman-like growth to still get decent, even outsized long-term total returns. Yes, the key is making sure that high yield is sustainable, and that's what I focus on. That's what I specialize on. I look at the balance sheet, I look at the business model, I look at the cash flow statements, I look at the management strategy, and I look at all that to determine, okay, is this dividend one that I can count on through the vast majority of scenarios? And then on top of that, what is a very conservative but achievable amount of growth that they can achieve on top of that dividend yield? And if the two of those combined, are about 10% or more, I generally view the stock as worthy of potential investment, especially if on top of that, the value, which is often the case if those two things are true, the valuation multiple is typically at a discount to where it historically has been. It's not pricing in that extra growth. And so then I can add that on as even potential further upside down the road. But even if the market doesn't cooperate and I don't get any valuation multiple expansion over the long term, I know if that growth happens, that yield is paid, I'm going to still get a solid double-digit annualized total return. But if the valuation multiple expansion happens quickly, great, I can sell the stock, take advantage of market's generosity and recycle the capital into a new opportunity and further accelerate the compounding process. And that's really the bottom line. That's what I do. And that's what I specialize in. And that's how I've been able to beat the market quite handily using high-yield investing approach over a number of years now. And it's worked well for me. That being said, again, I have to be looking, are some high yield stocks overrated or underrated by Mr. Market? And that's how I make my living. I'm a value investor. I see, is this high yield stock overrated or is underrated? And the simplicity of the valuation model of the most high yield investment stocks, business models, make it a relatively easy proposition. And I like to play easy games if I can because they're easier to win. And so in this video, I'm going to walk you through two of these stocks that right now I think are overrated by Mr. Market despite being popular and good businesses, and two that are underrated. Before I get into that, if you could please give this video a like, I'd greatly aid in its distribution, help me grow my channel. I'd be greatly appreciative. Thank you very much. Okay, so the first stock that I'm going to discuss today that I think is very overrated by Mr. Market is Essential Properties Realty Trust, ticker symbol EPRT. It's a triple net lease REIT, and it's a great company. I'm a former shareholder myself. I've made massive returns on it. It's great. I don't own the shares today though, and this is why. Biggest thing is that it trades at a massive premium to its valuation. It trades at like a 45% premium to its consensus net asset value compared to peers like Realty Income, which is an industry blue chip, trades at like a mere 10% premium to its net asset value. So there's a huge valuation disconnect there. Yes, premiums are great because it enables them to raise capital very creatively and invest at a higher spread. And that's a virtuous cycle. But at a certain point, you don't want to necessarily have a discount to NAV unless you have a good way to close that gap. Then it's great in the triple net lease space, but you also don't want to have a massive premium because the moment you fail to live up to that and deliver that high growth to warrant that massive NAV, your stock price is tumbling down. That will wipe out your dividend, that will wipe out your growth potentially for several years in terms of total returns. And so that premium to NAV is just getting way too high. Historically, it's only averaged about a 15% premium to NAV. So again, even though it's a great company and growing fast, a 45% premium to NAV is about 3 times of a larger premium than EPRT deserves. Additionally, as a result of that big premium, their dividend yield is quite low. Now it's below 3.5%. And, again, for a triple net lease REIT, this isn't an NVIDIA. This isn't some high growth, innovative company that's just going to see growth accelerate and blow people out of the water. It's a triple net lease REIT. It's a boring business at the end of the day. Very simple, very limited growth. Analysts are guiding for, even with its massive premium to NAV, they're still only guiding for about 5.5% annualized FFO per share or AFFO per share growth, or even dividend per share growth for the next several years. And so, that's solid growth, but it's nothing to get excited about. And a 3.5% dividend yield at best, again, combined with that, it's probably going to get you 8-9% annualized total return. Decent, okay. It might match the market if there's no valuation multiple correction there, but I don't invest to get an 8-9% annualized total return. I invest to get a 15% or even higher total annualized return. And so, again, I just don't see how this is an exciting REIT. I see its valuation multiple being way too high, especially because its credit rating is quite low compared to most of its peers. The quality of its underlying assets, mostly car washes and a few restaurants and another couple real retail assets that, frankly, especially car washes, are not very easily converted into an alternative use. Car washes are a bit of a bubble. If we go through a recession where people are cutting back on their disposable income and start washing their own cars, for example, that's going to really hurt them. And so, EPRT has a great track record. I'm not knocking them as a business. I just don't want to pay a 45% premium. Even their AFFO multiple is at 19 times compared to the historic average, about 16 times. Again, another big valuation premium there. And that's even with the 10-year treasury being at a higher level than it was a few years ago and for much of EPRT's history. So, when there's still a lot of REITs out there that are trading at discounts on a valuation multiple basis to their historic averages, I just don't see what is so compelling about EPRT to make me want to pay such a massive premium for them. Now, what is an underrated REIT right now, especially a triple net lease REIT that I can compare to EPRT? Well, I think WP Carey is one. Now, again, they've had their issues in recent years. They've had to exit their asset management business. They've had to exit their office business. They've had to sell off their U-Haul properties. That was a tough thing. They've had to navigate some pretty intense debt maturities. They've had to deal with their Marriott dispositions. They have a private storage business that they're holding for now, could sell. They've got a Lineage holding, which is a cold storage real estate company that they hold the equity in, that they're looking about trying to exit. So they've got a lot going on. I understand that it's a bit of a complex story. They had to cut their dividend last year a little bit as they exited office to try to offset that and retain more capital. But in spite of all that, looking at them on a forward-looking basis, they have a BBB plus credit rating, one of the best credit ratings in the entire REIT space and triple net lease space, really second only to Realty Income among triple net lease REITs in terms of credit rating. They have a very well-diversified business model with exposure to Europe and the United States. That benefits them by giving them a lot of attractive growth opportunities in Europe. Realty Income also said recently that their Europe business is growing a lot faster than the rest of their businesses, and the same can be said for WP Carey. This gives them access to lower cost debt in the Europe markets, which again strengthens their balance sheet and their cost of capital. They also get access to a lot of CPI-linked rent escalators through their European investments that makes them one of the best positioned REITs for all kinds of macro environments, whether, if inflation is low and interest rates are low, all triple net lease REITs, including WP Carey, do well because they got the long duration cash flows. They can finance them on a very cheap basis. They can refinance debt at lower rates, et cetera, et cetera. But if inflation is high and interest rates are high, triple net lease REITs generally struggle mightily, and the last few years have showed that. But WP Carey is an exception because, again, their CPI-linked rent escalators mean that their organic growth spikes up. So yes, their external growth, their acquisitions, their ability to issue equity and raise debt at attractive levels is not as good in that environment, but it's no worse than their peers. In fact, it may be even a little bit better because of their exposure to Europe and the US. They can be more opportunistic between the two. And they have the CPI-linked rent escalators. And so they get that stronger organic growth, so they're not as dependent on inorganic growth in order to generate their total growth. And so when you combine all that with the fact that they're heavily exposed to industrial and warehouse real estate, which is generally higher quality, has a higher premium attached to it than a lot of the retail stuff, especially the car wash type stuff that EPRT owns, and you have a recipe for one of the highest quality triple net lease REITs out there on a forward-looking basis. With their reset dividend, their payout ratios in the 70s now, it can now grow nicely in line with AFFO growth while still retaining sufficient capital to grow the business. It's an underrated REIT, and it only trades at like a 10% premium to net asset value, which again is not cheap, but compared to peers like EPRT, it's definitely underrated. And I think there's a lot to like about WP Carey. Its dividend yield is well over 5%. It trades at a discount to its historic average on a priced AFFO basis. Again, its portfolio has never been stronger. Its balance sheet has never been stronger. It's dealt with all these previous issues. And on a forward-looking basis, it's looking good. And so that's why I think WP Carey is definitely underrated, especially compared to EPRT and even some of its other peers like Agree Realty in the triple net lease space. Now, another overrated stock right now, I'm going to shift over to the midstream space now. And there's one called ONEOK or ONEOK, however you pronounce it. It's ONEOK. It's ticker symbol OKE. And this business, again, it's very solid. It acquired Magellan Midstream Partners recently. That was a midstream I really liked. Really great refined products business. So it's got a very diversified portfolio across refined products. It's got natural gas. It's got all the different commodities, pretty much well-diversified portfolio in the midstream space, strong investment grade balance sheet, solid, 3 to 4% growth target for its dividend. So it should beat inflation. But its dividend yield is only a little bit over 4% because the stock has just soared recently. And yes, sure, it's a good business, but I just don't see, add those two up, you're going to get maybe a 7, 8%, at best 9% annualized total return. And the valuation multiple premium is steep at nearly 12 times on an EV to EBITDA basis. That's one of the most expensive midstream businesses out there. I just don't see how it warrants such a massive premium to its net asset, on a valuation multiple basis, especially because the growth is not particularly energizing. And so when you add all that up, I think OKE is overrated and at best can deliver market level, but likely even market less, lower than market or market lagging total returns over time moving forward. So what is a midstream that I do like, that I think is underrated? Well, it's Enterprise Products Partners. Best credit rating in the sector, A-, extremely low leverage ratio at 3 times, huge amount of liquidity, well-laddered debt maturities. There's not a care in the world with this stock. This stock is a true sleep well at night stock. It yields over 7%. The distribution is covered 1.7 times. Company's been growing at about a 5% CAGR, expects to continue doing that moving forward. They have a large growth pipeline coming online in the next few years, which will cause, once that's done, their CapEx should drop, their free cash flow should soar as their EBITDA rises from the projects coming online. It's going to give them a huge amount of cash and reduce their leverage ratio by a meaningful margin so they can return that capital to shareholders through buybacks, through dividend growth, maybe or distribution growth technically, or a one-time special distribution, or through a major acquisition, which they have a great track record of making good, smart acquisitions as well. Insiders are well aligned, owning 1/3 of the equity. EV/EBITDA multiples in the 9s, which is a discount to the historical average and way lower than OKE's. And so there's so much to like about this midstream. Sure, no investment is risk-free, no investment is perfect, and EPD's unit price has floundered for quite some time. It's hard for me to know why that is. Management has expressed similar frustration why it's trading where it is. But all I know is when I see value, I take advantage of it. And I think EPD is a screaming buy right now. Good bargain, especially relative to a lot of other high yield stocks right now. And so hopefully this analysis was useful to you, gave you some good ideas of both what to steer clear from as well as what are some good buys right now, helps you see my thought process and how I evaluate stocks to buy and stocks to sell, and how I rotate capital and recycle it opportunistically to generate long-term outsized total returns while also growing my dividend passive income snowball. So if you liked the video, if you could please subscribe to this channel to get future content, it would really mean a lot to me. It'd really help me to grow my channel and make it more worthwhile investing this time and effort to bring you good quality content. Thank you very much. See you next time.